All right, good afternoon, everybody. My name is Katie Ensweiler. I'm the marketing manager here at VonLehman CPA Advisory Firm. A lot of housekeeping items to go through before we go ahead and get started, so just go ahead and bear with me. As you heard, the event is being recorded, so if you need to reference something later on, something that you missed, or you just want to share with a coworker, family, or friend, you are more than welcome to do that. We also encourage you to please submit questions through the chat feature. We get to them as best as we can, but we do only have 1 hour today. I also ask that you please keep yourself on mute and your video off. It will eliminate distractions that we have throughout the presentation today. Huge thank you to our partners at HORAN and Graydon for being a part of this event. This is our 4th series this year. They've been great partners throughout the entire thing, so we really appreciate their dedication to the series. Before I turn it over to Beth Weiss, our shareholder, who will be moderating today's panel, I did want to tell you a little bit about each of the panelists you will hear from today. First is Carrie Walls. Carrie Walls joined VonLehman CPA Advisory Firm in 2013 as a part of an acquisition of Dunbar, Cook & Shepherd. She had joined Dunbar, Cook & Shepherd in 1998. She is a CPA and manager specializing in ERISA plan audits. Carrie specializes in employee benefit plan auditing and accounting services for small to medium-sized closed-out businesses. You will also hear from Paul Carl. Paul is a vice president at HORAN, leveraging his unique experience as a former Department of Labor senior investigator to design and manage plans to help employers mitigate risk and employees retire successfully. Paul is a valued resource for his industry peers, as well as, most recently, a panelist at the 2021 National Association of Plan Advisors Summit in Las Vegas. Very jealous, always love a good excuse to go to Las Vegas, and you get to hear from Paul, so win-win there. And our third and final panelist today is John Kirk. John is the chair of Graydon's Employee Benefits and Executive Compensation Practice Group. He works with employers on issues related to the offering and administration of retirement, pension, and health plans, and executive and deferred compensation plans. A significant part of John's practice is to represent employers on employee benefit matters involving the IRS and the U.S. Department of Labor in litigation, plan audits, and IRS and DOL plan correction programs. With that, I will go ahead and turn it over to Beth Weiss.
All right, thank you, Katie. Good afternoon, everyone. Thank you so much for joining us. For those of you that I don't know, I'm Beth Weiss with VonLehman & Company. I am a shareholder here in the audit department, and I am heavily involved with our employee benefit plan audit practice, just like Carrie. We audit about 70 of those plans every year, so quite a lot of audits to get out the door. We have a lot more clients that are falling into the need for an audit, as many of you are probably in that same boat. It's not too hard to cross that threshold where you need an audit. But the info today that we're going to share, not just for plans that need audits, these really, a lot of these really relate to any employer with a plan. Even if you don't, rise to that level of needing an actual plan audit by a CPA firm. So similar to Katie, I want to thank our partners. This has been our 4th event this year with Graydon and HORAN, and they've been fantastic to work with and just a wealth of knowledge. So, today we're going to cover, some of the things that we see in our audits, but I think even more importantly, we have Paul and John here to tell you how to fix those things. So oftentimes, we're the bad guys on the audit side, and we maybe find an issue, and then we need to get someone else involved on how you can help fix that issue in your plan. But there's also some new things coming down the pipeline, just some best practices and some other things that we want to make sure you're aware of on the retirement plan side. So we'll get into some of those items as well. So I will get started here. Like Katie said, if you have any questions that you want to ask the panel, feel free to put those in the chat function and we will try our best to get to those. So I'm going to start with Carrie, just kind of start from the beginning here. What are just a few general things that plan sponsors can do to prepare when they do have to have an audit by a CPA firm?
When they do have to prepare, some things that they can do to prepare is they can make sure that first and foremost that we have access to the TPA and custodian websites so that we can start to download those reports and any other reports that we may need. That will take some of the work off of them. The other thing that we need to get is the new plan documents, summary plan description, plan amendments. And we need the most up-to-date documents because that's important that we're looking at the most current plan provisions and that we're testing those items. Another thing that we need is plan minutes. Sometimes plan sponsors don't always keep records of those, but it's very important that they do document what they are doing in those meetings. And so we ask for the minutes for that entire year as well as after the year end. We also ask for census data, which usually you can download from your payroll provider or TPA, and it will have your date of birth, date of hire, date of term, the status, whether they're full-time, part-time, the wages, deferral match, and have that all tied out to payroll for us so that we know we have a complete census, and then we pick our samples from that and start to test. Another thing that you need to have available are payroll records and any personnel files. A lot of times we're asking for I-9s that will have the date of birth and date of hire on them. We're also looking for date of term. So we're looking at those records and we're trying to make sure that those agree to what is in the census information to check eligibility investing. Another thing that we like to have, if possible, and you can usually download this from your payroll provider, is a list of contributions by payroll date so that we can do a timeliness test and compare those dates with the time that the money got put into the plan. And another thing that we like to look for or have that is documentation of their internal controls from the plan sponsor. That's really important so we can see what they are doing and how the plan works. So those are the main things I would suggest that the plan sponsor have ready for us when we come out to audit.
Thanks.
Carrie, you
Go ahead, Paul.
sorry, Beth. No, you brought up something.
Mhm.
So a lot of the record keepers do have unique auditor only access.
Correct.
Yeah. So do you all use that feature as often as you can? And
Yes, we do. And that really helps us out a lot to get that access. It helps the plan sponsor not to have, a lot of times we can just download the reports we need and we don't have to ask the plan sponsor to go out there and get the information because sometimes they don't know what we're looking for. So it really just helps us right away get the information that we need and can pick our samples.
awesome.
Okay. Paul, I'm gonna go to you next. Carrie touched on some of these things already, but as far as the TPA, the record keeper, the advisor, how can all of those people that really help the plan on an everyday basis help the plan sponsor prepare for one of these audits?
Yeah. So, the record keeper, the TPA, us as advisor, we're keeping records as well. So if the plan sponsor is having difficulty finding the meeting minutes, for example, and as long as, we as the advisor have been present at all the meetings, hopefully we have been, we should have copies of them that we could share. The record keepers have a myriad of reports that if, can be run through the access that the auditor is given. And compliance testing that a lot of times will have sensitive information on it. So the plan sponsor maybe wants to keep that in a special place. And if they're like me, that special place is so good, I hide it from myself a lot of times, right? So the TPA will be able to, reproduce copies of all that information as well. So that's, you can fall back on us. Plan sponsors can fall back on their providers in cases for a lot of this information.
Okay. John, kind of related to that as well. Can you kind of walk us through what you call a fiduciary file that a plan sponsor could be maintaining? What goes in there, what doesn't go in there? How do people keep that up to date? Just some of the best practices around that.
Okay. And you can look at my picture, but it looks like I'm going to pop up that since I've dialed in with my picture up there also. For a fiduciary file, it's a lot what Carrie just mentioned and what Paul mentioned. We want to see the most up-to-date plan documents. Those should always be the core of your fiduciary files, because that's what you have to follow to make any decisions about the plan is you need those plan documents. You know, the base plan document, your adoption agreement if you're using prototype plans, your most recent SPD, any summary of material modifications you may have done. Usually you might see a Form 5500, your most recent 5500 in there just to have. But from there, you're going to want to see, as Carrie said, the minutes. You know, as we've talked, if you've listened to some of our other series this year, you know, we've talked several times about, you know, fiduciary decision making, and one of the things you need to have there is you need to show what that process was that the Department of Labor ever investigates. So minutes are very important of your meetings, and so whether it's a copy you made or your advisor made, you know, took the minutes and provided them to you, or however you have them, as long as you have, you know, here's what we talked about, and here's what we decided, you know, have those in the file with that. Then it's, you know, do we have an investment policy statement? You know, some plans really like having an investment policy statement. Some plans have gotten away from having one. That one I'm sort of 50-50 on. I think it's what matters to your company and how you like it. There was a big push maybe 5-10 years ago to everybody have one, and then it sort of went to everybody doesn't need one. But if you have one, you need to have it in there. You know, so that fiduciary file should really be the things you as the fiduciary rely upon to manage the plan. That could be, you know, it could be very, very thick. You know, it could be, here's every prospectus we've got when we evaluate all the plans and we keep all that. I think that's probably overkill. You really need, here's what we've chosen, here's why we chose it, and here's how we're sort of going to implement it. It would be in that folder. And that can be a digital folder. It can be an actual folder. Used to be, you know, I used to have that sort of that binder with the plan documents in it and the investment policy statement, all those sorts of things. You'll still see some of the long-term committee members when you go to a fiduciary meeting or a retirement investment committee meeting, carrying their binders in. Other people have their laptops, but it should all be the same stuff. You know, you want it close at hand, so when your auditors need it, when you need it to make a decision at the plan, just on the plan level, it's there and available to you.
Yeah. John, you touched on minutes, and I know we've talked about minutes in some of our other events this year, but maybe for those people that weren't able to attend previously, what are some good examples of things that should definitely go in those minutes?
Yeah, so for your minutes, and I recommend 100% that you have minutes of every committee meeting you have. Even if it's a Zoom call or whatever, there should be someone taking the minutes. So you want to see who was there, you know, basics, when did it take place and who was there, the first two, just so you can say, hey, yes, we had quorum, yes, everybody was there, those sorts of things. And then you don't have to have, you know, we talked about where to have lunch and we talked about where to go on Friday night. It's, you know, we had a meeting. Paul from HORAN was there as our trusted advisor. He recommended, you know, that we review the investments. We reviewed the investments. We decided based on the performance after Paul did his presentation that we think we need to replace these two funds. We then asked Paul for his recommendations on which funds might be good replacements. You know, we evaluated his recommendations and we chose this fund for XYZ reason. And, you know, we decided that fund will get replaced effective this date. Or, you know, we've decided to, you know, if we have a discretionary match, we've decided to either, yes, make the match this year or not make the match. You know, so anything that impacts the participants or the plan administration, you need to have a record of. And, you know, I always say err on the side of caution. And so any decisions you really make about the plan, you should have listed. For sure, any material decisions, you know, investments, money, eligibility, those sorts of things should always be recorded somewhere, because anytime you make a change, someone's going to be upset about it, and you're probably going to hear about it one way or the other. And so if you have a record of what that change was and why the change was made, you just have more protection. You know, if I get involved in litigation or an audit, defense, you know, if they say, hey, we don't have any minutes, well, why'd you do that? Well, no, we don't really remember. You know, that's a much harder case to make than, well, I don't remember, but we have this contemporaneous these minutes, and look, we did it. They don't have to be giant paragraphs. It can be just a couple sentences about each thing. Here's what we did. Here's why we did it. Why'd you do it? We got rid of this fund because it was losing money every month for the last 6 months. We added this other fund because it has a great 12-month track record, and the fees are a little less. Remember, you don't always have to check or pick the cheapest one, but you should have a discussion somewhere in there about fees and why, if it has higher fees, you maybe chose that. The fees are a little less, and it gives a nice option for our participants. That's your minutes.
So I'm curious, Carrie, or Beth, but Carrie, how many clients that you're auditing, how many do not have minutes?
Most of them do, but especially like our first year audits that we get, they don't. And sometimes, especially with COVID, I would say they weren't documenting them. Maybe they had, like you said, a Zoom call, John, and they just weren't documenting them. So I don't know, Beth, I think most of them do.
Yeah, it's better. Once we, especially once we get a new audit in the door and we start telling them, if the Department of Labor comes knocking, they're going to ask for minutes. So start taking minutes. So we're not as mean as the IRS and the Department of Labor. We're trying, if nothing else, to prepare you, so please have these. So I will say, I think it's a lot better than, call it 5, 6, 7 years ago. I think a lot more people are aware of it. But we certainly do run into plans that don't always have minutes. And that's always something we ask about and recommend that they get those in place.
Yeah, and that's something we talk to clients, especially as they're getting a little bigger and getting to that audit requirement, and they're putting the plan in and now they need an audit requirement. Is here's sort of the best practices you should do in minutes. Should be one of them, and sometimes that sort of falls on deaf ears, and all of a sudden the audit, like, oh yeah, I remember they mentioned we should have had minutes. And usually, once you get sort of chastised the first time, it gets a little better.
I'll just chime in from an advisor standpoint. If we're at the meeting, we're taking notes and converting them into, in effect, draft minutes to send to our client to formalize. So that's it's a good best practice that we exercise on a regular basis, for sure.
Yeah, it's the same if I attend retirement committee meetings. Sometimes the committee will have a secretary who takes those minutes, but I'm always taking notes as well. So if one, it could be minutes if we needed them. Two, it could be could help supplement those meetings with secretary or whoever took to flesh them out a little better.
Exactly.
Beth, I don't know if you saw the question that came through for the panel. Okay, perfect.
Yeah, it's a great question. And hopefully John, being the attorney, knows. I have no idea. The question is reading a Zoom call or recording a Zoom call an option in lieu of minutes?
It could be. I think your issue with that becomes there may be things you discuss during that meeting you don't want recorded. And especially if you find out you're going to have to turn those meetings over to one of the administrative agencies, or you are now in some sort of dispute and you have to turn it over to a participant. And so there very well could be many things you've discussed during the meeting that are important, but maybe shouldn't be in the minutes that you give to somebody. And if you give minutes and you have the minutes, they're signed by the secretary, that's what they are. If I receive an edited Zoom call, I as the attorney or I as the plaintiff's attorney are going to have a lot of questions about what's missing from that recording. So yeah, I think you can do it, but as a best practice, I would recommend you take that recording and then at your leisure summarize that into some sort of written document.
That makes sense. All right. Okay, Carrie, I'm going to turn it back over to you. So obviously one of the things that we wanted to talk about is just some of the things that, we find on a regular basis when we do audits. Again, like I said, I feel that we are a lot nicer than the IRS and the Department of Labor. But, we still do a lot of testing during these audits and find, certain things. So maybe just walk us through a few things that you often see when performing these audits. And then kind of as we go through them, John, Paul, if you want to, just chime in on what you see or maybe possible fixes for some of these things, I think that will really help everybody.
Yep. So of course, the minutes, that's one we usually do find. So I won't say any more about that, but again, we would just recommend that you at least have one a year and make sure that they're documented. Another thing that we see is sometimes newer plans are not doing the benchmarking of fees, which I know John already addressed a little bit, but I think the DOL requires that be done every 3 years. And so we would recommend that that's done at least every 3 years and maybe every 1 to 2 years. I think we would recommend that. Now, John, maybe I misheard you, but we normally, if we don't see an investment policy statement, we're usually issuing a management comment for that, that we recommend that they do have that. So I don't know.
Yeah, that was, like I said, a couple of years ago, that was sort of de rigueur. Everyone had an IPS. A lot of people are moving away from them.
Okay.
One, that way, if you don't follow it, you didn't violate anything because you didn't follow the thing you don't have.
Sure.
And two, things change. Especially like as ESG becomes an issue, the environmental, social, and governance issues, and those are sort of hard to articulate. Those are a little more touchy-feely than just straight performance. So, if someone doesn't have one, I usually would mention it to them and sort of talk pros, cons, and then they decide. And,
Okay.
and I see those management those comments all the time. Hey, that don't have one.
Right.
And sometimes I'll get a phone call say, hey, our auditor said we need one of these. Do we?
Right.
And so then we'll sort of have a discussion. Do you want to do this? Or not?
Sure.
We prefer an investment policy statement be in place. I mean, for us as advisors, it gives us a roadmap to follow.
Absolutely.
Now we can help draft. We'll review the current IPS or investment policy statement, or we'll even help draft it. We've got, sample language, but it is sample language that we recommend, the attorney review and formalize. But, at the end of the day, it helps us do our job. And then we make it a point to review the investment policy statement, if not on an annual basis, at least every 2 years, just periodically review it and see if it needs to be updated. Make sure, obviously, we're following the details of it. We prefer them.
Personally, I prefer them also. For example, what Paul said, it's a roadmap. And especially as you change maybe committee members, on your investment committee, it's a nice sort of welcome to the committee, sort of here's what we're doing and here's why we're doing it. Or if you change advisors or you change record keepers, or any kind of transition, it's a nice, like you said, Paul, it's a nice roadmap for our philosophy for investing. It helps people. But, some people, they prefer not to have one, and I understand that completely as well.
Yeah, and they're not mandatory by the DOL. So
exactly.
Yep.
And usually the DOL will ask if you have one, and if you give it. The times I've had to produce one, they've never really commented on it. And the times I haven't produced one, they've never really commented on it.
So we would typically, if they didn't have an IPS, we would recommend that they do get an IPS. Another thing I think that I had already mentioned was making sure personnel files, date of birth, date of hire, date of term, agree to what's at the TPA and at the payroll records, because if they don't agree, that could affect eligibility, that could affect vesting. And sometimes it's only, maybe 10 days off or something, but depending on your plan provisions, it could really affect those things. So we would recommend that they make sure that the census data agrees to the personnel files. Sometimes we see late contributions. So what we do is we compare, like I said, the payroll dates to the time that the funds got placed into the plan. And we're looking for a trend. Usually we'll see a trend with the plan sponsors. Maybe they're getting them in every 2 to 3 days, or maybe the next plan sponsor is getting them in every 4 to 5 days. But we'll see a trend, and then we might see one that's like 10 days or 8 days, and it's an outlier. And so we will ask the plan sponsor, hey, what happened? And sometimes it's, oh, we just forgot until the next payroll, or we went on vacation and we didn't have somebody to back us up. And so in those cases, we would recommend that they make up for lost earnings on those and get with an ERISA attorney and make corrections on that. So John, I don't know if you want to say what you would recommend, and Paul, if you want to recommend some prevention.
Yeah, I would say, they mentioned, Paul spent his time at the DOL. I was at the DOL for 3 years. That's probably the most common error or correction you see. Within the practice group, I think we're working on 5 corrections right now for late earnings. And nothing, malicious or anything like that. We had somebody went on vacation. All those sort of reasonable causes, but we still need to fix it. And so the bad part is you have to fix it, and sometimes people complain because now I got to put $1.50 or $2.78 into somebody's account because it was a few days late. But the Department of Labor says you have to have them deposited as soon as administratively reasonable. And in the old days when we used to mail you'd mail all your checks in, or be a long time thing, 3, 4, 5, 6, 7, a week. Never really thought of it. Now that everything's electronic, the government essentially thinks you should be doing it within the same day you send your payroll taxes in, if not within a day or two. And so you start getting much outside of that, and a lot of questions get asked. The good news is you can go through the Voluntary Correction program. They have an online calculator you can use. I will say I think their interest rate is a little generous to get the most interest to the participants. But if you're not, super late, you're not talking a lot of money. So you just, to correct it, you go through the correction program, you make sure the money gets in there, you put it in the lost interest, you document it to the file, and you get it done. As far as sort of best practices is just, if someone's going to be on vacation, or hey, we got payroll date coming up, just think of how you're going to cover that. Because again, if you can get your payroll taxes and other monies in the same day, you should be able to get that wire transfer to your record keeper for the plan money the same day or real close to it.
And John, that's one of our best practices, is really have 2 people involved in this process throughout the year, because invariably, one of them will be on vacation, but it'll make sure that the process is continual. I'll say the other nice feature is a lot of payroll providers, payroll companies have been working very closely with a large number of the record keepers. And there is something called 180, where the payroll company will perform the withholding. They will upload the file directly to the record keeper. That's a signal then to the record keeper that they can pull the money out of the plan sponsor's funding account to fund the contributions. And there's also 360 available in some cases as well, which is even a payroll company and a record keeper system talking very universally with each other. They're getting that established, following protocol, making sure that you've met cybersecurity standards, obviously. But those are all items that can prevent these, little nuances of the missed or delinquent contributions, for sure.
Yeah,
Paul, you bring up a good. Sorry, go ahead, John.
But I would say, to Paul's point, I think having 2 people with access to things helps you. Plus, frankly, it helps. As far as the best practice, it helps with fraud. If one person has access to everything, well, you never know what could happen. If 2 people, well, now we've got a bit of a checks and balance. But 2, anytime you can take people out of the equation, why didn't it happen? Well, so-and-so got sick and they couldn't hit the send button to authorize the wire versus, it's set up automatically. So ADP triggers, Empower to immediately take it out. That just, once if one person can initiate the process and then it just sort of automatically happens, you're going to run into a lot fewer problems. It's always easier to sort of fix a computer glitch than try to explain away why someone didn't sort of do the thing they're supposed to do.
Yeah. John and Paul both have mentioned, having kind of a backup, someone else trained to do this. And I think it's a good idea on the contribution side and just in anything related to the plans. What we run into a lot is one person is doing everything. And it's like John said, that's a, potential fraud risk, but it's just a, a general corporate risk as well. If, if that person got sick, that person, leaves and goes somewhere else. Is there even documentation of just everything that person does in regards to the plan? Because this is just something else that you've got to keep going, if that person can't be there. And that's something that we recommend a lot too, is just to make sure that, these things are documented. Someone else knows how to do some of these things, because you just never know what's going to happen. We recommend that obviously a lot on the accounting side and our financial statement audits, but it's just as important in these plan audits, because there's a lot going on with these retirement plans. And, when one person is the only person that knows about it, that doesn't often lend itself very well if something were to happen. So,
yeah.
Okay, Carrie, anything else on the comment side?
Another one that happens frequently is the definition of compensation is not always correct. So, let's say a plan defines compensation as W-2 wages. And so the employer is withholding deferrals, every paycheck and remitting match every paycheck. And then they pay a bonus out in December and they forget to withhold deferrals on that we see that quite a bit when we are doing our testing. The calculation just won't come out quite right, and we'll investigate further and we'll find out they didn't withhold on those bonus checks. And so we'll ask for an opt-out form, like the participant opted out of having deferrals on that bonus. And if they can't provide it, then we have to issue a management comment for that. And so we would suggest that they get with their ERISA attorney to make corrections on the incorrect definition of compensation being used.
Yeah, that is one we see a lot. And it comes up most frequently when you're using a Fidelity or a prototype or just a off-the-shelf kind of document, and you run through that adoption agreement. And as much as I would love for everyone to send me their adoption agreements as they're going through it so we can walk them through it, most people don't. They sit down with the vendor and just sort of run through, and that governs the entire scope of how the plan operates and everything that's included. And they probably spend 2 hours on it, maybe, if you got a good meeting, and there's checking all these boxes. And comp a lot of times gets sort of missed because, there's 3 or 4 different definitions of compensation throughout the document, and you can't always remember which one you did for everything. And so we see a lot where they meant to do one thing because that's how everything works, but they checked the wrong box. And so we can correct it. We may have to go back and fix some, like Carrie said, sort of some opt-out, make sure we take care of some opt-out forms or have that available, or amend going forward the definition of compensation so we can reflect what they actually do in practice. And then, we can always go through one of the correction programs. And when I say correction programs, there are ones where you actually have to do filings with the IRS, and then there's also the self-correction program, which they've actually expanded quite a bit recently to encompass more potential errors. So there are ways we can correct without actually involving the IRS. We just follow the methods they've laid out and then put it in a file somewhere. So if we ever are audited, we can show we corrected it under their methods. But comp is probably the number one thing we see and usually comes up about a year or 2 into having a new plan or having a new plan document with a vendor. And either the auditors catch it and the participant catches it. For example, they got a big bonus and they said, hey, how come money didn't go into my account? I thought it was supposed to. And so eventually it'll come up somehow. But again, we can fix it. And it's not a very hard fix. It's something that's much easier if we can catch it on the front end when we're filling out the adoption agreements.
Anything else, Carrie?
Nope, that's all I have on that.
Okay, perfect. Okay. John, I'm going to kick it over to you. So I think Paul may have mentioned it, but I know there's some new initiatives out there from the DOL around cybersecurity. So, cybersecurity is a big deal everywhere. Retirement plans are getting hit as well. So can you kind of give us an update on what's going on there and what the Department of Labor is saying about that?
Sure. So you may have seen it, you may not have, but maybe probably 4 or 5 months ago at this point, the Department of Labor issued guidance. It's not mandatory guidance, it's more just the best practices for FAQ type guidance on cybersecurity. And they said, here's what we think you plan sponsor, and it wrote on health, welfare, retirement, any kind of ERISA governed plan. Here's what we think you should be doing as a fiduciary with regard to cybersecurity. And truthfully, all they really did was sort of cut and paste, maybe like a top 10 thing you should have done that you could have found anywhere on the internet. But the importance is now the government has officially said, here's what you should be doing. And as part of that, at least in the last few DOL audits I've had with clients, they're now, when they send you that long list of here's all the things we want you to provide us as part of the audit, cybersecurity policies and procedures has now made the list. And so when you have a plan and as a fiduciary, you need to be now, do we have a cybersecurity policy and procedure for the company and for the plan? And it may be identical to the company, but you should have one sort of specific to the plan. As we're making contracts with our vendors, are we discussing cybersecurity? Is cybersecurity addressed in our services agreements? Is cybersecurity liability insurance? We talk about, maybe directors and officers insurance, fiduciary insurance. Well, now we should also look at cyber insurance. Is that in there, and is that protecting the plan? Getting with our IT department, make sure, plan communications, plan documents, plan everything is secure as we transmit to all our vendors. I mean, if you think about it, we're taking a lot of money and we're sort of wiring it out into the ether. And yeah, they're going to big trusted companies that we've used for years, but that's exactly the kind of thing that criminals are looking for. There's quite a few cases coming up now where fiduciaries have been found liable because they get an email from somebody that says, hey, I want to take a distribution from my retirement account. And they don't really ever verify it. They see the name, it says the right name, it has the right social security number, and they just wire the money. And then they get the call from the participant say, hey, what happened to my $100,000 that was in my retirement account? They go, what do you mean you requested it? And here, they got essentially a phishing scam or something like that. And then they didn't follow procedures by getting signatures or verifying. So, all those things we have in place, the DOL is now looking, hey, did you follow all of these things to cut down on scams and theft? But it's something that, every year I think we hear more and more about, this person got hacked or this person had ransomware. Criminals are now turning their attention to retirement plans because there's a very, very large amount of money sitting in these plans, most of which is transferred electronically at all times. And so there's great potential for criminals to have access to that. And so now we need to be thinking, how do we protect that, just like we protect anything else? Just like a regular bank account, you as a fiduciary need to protect your participants' money.
And John, the record keepers, a number of them have come out with very specific cybersecurity policies themselves. In some cases, they've got protections or guarantees that if there is a breach or a violation of their system, they will make the participant whole if it's, on them, so to speak. In some cases, they're willing to, maybe it's not full coverage or protection, but there's some, and there's some smaller record keepers out there that frankly haven't adopted any policies as yet, but I would suspect, given that the Department of Labor is really putting the emphasis on cybersecurity, I would expect really all the record keepers to have something in place pretty soon, for sure. The other item I might mention related to cybersecurity, and I just heard this the other day. I hadn't really personally thought of it. There's a plan administrator that once a month will download a report of everyone's account balances and just keep a copy of that, just in case their record keeper gets scammed and the system is locked up unless they pay a ransom, ransomware. So I thought that was kind of an interesting, easy tool to help combat a little bit of this potential cybercrime.
Yeah, no, it's kind of old school, but I like it. Just print off and have it saved somewhere that they can't access.
Yeah.
And Paul, to your point, a lot of the new cyber policies are pretty good, and they're nice that they're taking so much effort to sort of put it in there. And I think as a fiduciary, if you're comparing vendors and someone is very upfront with their cybersecurity and someone doesn't address it at all, you need to take that into consideration as you're thinking about that vendor, because if they haven't even thought about it, there's risk to you there. And again, if the government comes in and asks and says, why is this not even addressed? You can always add it to the agreement, but if it hasn't even been addressed at all, it could be an issue. The other thing is we review, a little off topic, but we review business associate agreements these days. We're making sure we're putting in that, if the business associate has an issue, they're going to pay for credit monitoring. I think that's sort of just become you have to do that now. I think it's a best practice that in those agreements, any cyber agreement, if there's a breach, you're going to be on the hook for credit monitoring for the individuals impacted.
John, Paul, do you have any best practices? So we've got a lot of plan sponsors obviously on the call today, and in the world of distributions, so much of that is electronic now. I'm a participant, I go onto Fidelity, I request what I want, they send me my check. How involved should the plan sponsor themselves be in the process with everything going so much more electronic? Especially since they are a fiduciary of the plan, what do you see kind of as some best practices for the plan sponsor themselves in that area?
Beth, that is something that it's a way for plan sponsors to have some what do you want to say, tasks taken off of their plate.
Right.
And one of the key features in my mind with this is who is acting in the fiduciary capacity with regard to the distributions. If I'm the plan sponsor and my record keeper or my TPA is providing the I'll call the 316 service, then I want to be involved. I want some type of verification or proof that these funds are being sent presumably by check to the address that's been on file. If there's been a recent change of address, I probably want my TPA or my record keeper to explore that a little bit more, or maybe I'm going to do my own due diligence on it. It's going to take a little bit of extra time, but it's certainly better than some funds getting away. Could be a little cumbersome. There's more and more providers willing to take on that 316 fiduciary capacity and role. And, in doing so, they're taking on the responsibility to verify that that's a legitimate distribution request and that the funds are being sent in the appropriate manner. So, there's a little less liability or responsibility than on the plan sponsor's part in that case. So that's something that I'd be a little bit more careful about than maybe has taken place traditionally, just for the fact that we're seeing increase in cybersecurity breaches, and the potential is out there. Not saying that it happens, but the potential is out there. John, you want to weigh on that too?
No, I think that's right. And when Paul's talking about 316, he's talking about ERISA Section 316, which essentially your vendors agreeing to be a fiduciary of the plan. You know, a lot of times we see the service agreement say, we are absolutely not a fiduciary, never can be a fiduciary. Well, some of them are now agreeing to be a fiduciary for these. You know, I think it's going to depend on how big you are, as to how involved you are. You know, we've got clients, 10, 20, 30,000 employees. That's the kind of thing that they're not going to be involved in much at all. You know, if I've got 200 employees, you know, maybe I'm much more in the loop there, simply because it just doesn't happen as often. But
Right.
I think in either case, that's one of those places where you need to do your due diligence up front with the vendor on what those procedures look like. You know, that's one of the things that's going to be spelled out in your agreement and your contracts with the vendor is how that process works.
Mhm.
You know, so if you are a person who sort of says, you know, as much as I'd love to have that task taken off my shoulders, you know, I at least want you to check in with me, what, you know, say, hey, we got a request from so-and-so for in-service distribution or any kind of hardship distribution or anything like that. We're just checking with you to let you know this is occurring. And you know, plan sponsor, HR person may know that's happening, you know, or they may not. And so that's one little check. You know, other times, you know, the plan documents will actually say, you know, you'll make your request online, and then it has to be verified by the company itself, and then we'll respond.
Yeah.
You know, if you're in a spot where you think that works for your company, you know, that's nice, because that, to Paul's point, that adds a nice little check on that. So you can say, oh yeah, that's an actual employee. Oh yeah, they did terminate, or they did have this, or they did have that. You know, and so it makes sense. But if you're a giant company and you have tons of participants, one, you probably shouldn't be involved in that, because that'll eat up your entire day. But you should spend some time with the vendor in the beginning on what that process looks like. You know, maybe there's some sort of internal, you know, computerized electronic checks and balances you can put in, or just, you know, pings the payroll system and it looks to make sure that they're still employed, or those sorts of things, or pings to look for an updated address or something along those lines.
Yeah.
Okay, perfect. Okay. Paul, we'll send it to you. Just as we're approaching year end, let's talk about some best practices for retirement plans, anything out of the box that you kind of recommend people consider when it comes to their plans at year end.
So, you know, it is year end, calendar year end. It's notice delivery season. So just make sure that your participants are receiving all their required notices. Some vendors will produce the notice and issue them on plan sponsors' behalf. Other providers will produce the notice and send them to, you know, the primary contact at the employer for them to distribute. So just make sure that you know what is taking place and that the notices are going out to the participants. Great time right now too to review your terminated participants, their account balances, and determine if they are force out eligible. If your plan calls for it, and ideally it does, you can cause a cash out of someone's distribution if their account balance, vested account balance, is less than $1,000, or you can force a rollover between $1,000 and $5,000. There are some procedures in there that you need to follow before you can just do it, but you know, right now, mid-November, great time to take a look at that and get that accomplished. RMDs, required minimum distributions. Anyone entitled to or responsible for taking an RMD, you know, now's the time. If they haven't done it yet, December 31st is the due date. Especially if you are a business owner, you've potentially got to take the RMD if you meet the required minimum age. So just be aware of that. Some other best practices: forfeitures. Every plan document will address how forfeitures are to be handled and the timing of those forfeitures. That has been a DOL hot button the last few years, that forfeitures were not being used or being used properly. So make sure that that's taking place, and you're looking at that. And then another one is Fidelity bond coverage. At least once a year, you need to be taking a look, probably at renewal time on the Fidelity bond, but certainly doesn't hurt to take a look at it right now. Your plan's required to have a Fidelity bond that is equal to 10% of funds handled, maximum Fidelity bond of $500,000, unless you're an ESOP. Then it's higher, but that's a couple of that's a number of ordinary things to be looking at. Out of the box, we've talked about a number of these. One is great time to evaluate your plan's definition of compensation, and a great way to do that is to list all the types of compensation that you've paid throughout the year, and then sit down with your TPA, your trusted advisor, your ERISA attorney, payroll company, everybody. It just makes sure that the plan document definition is matching up with all the different types of compensation that you pay, and it aligns the way you want. And then frankly, it doesn't hurt to really make a laundry list of your providers and their roles. Who's a fiduciary, who's not a fiduciary. An auditor is typically not a fiduciary, but it's nice to have that consolidated with, who's your record keeper, who is your investment manager, investment advisor, and are they a fiduciary? And if so, what type of fiduciary, and so forth. These are all really great best practices as we kind of wind down the year. I would imagine it would make that audit go a little bit smoother too when that comes about.
Or you might actually be able to avoid an audit. So one of the things that Carrie and I run into all the time is if people would have forced out participants under what's allowed in the plan document, they may not have needed an audit, or maybe they could have at least pushed it off another year or two. And an audit, it's not cheap. It's $8,000, $9,000, $10,000 of the money, either the company's money or maybe even the participants' money that is spent on the audit. And again, we love to do these audits, don't get me wrong, but we see it a lot where, maybe they could have at least deferred for another year or two. And on that end, I'll just throw in one other thing. If you are approaching that number where you need an audit, just carefully double check that number. We've seen that a lot too, where people think that they have enough participants under the rules that need an audit. But when they really go back and review their census and all the dates and the definitions and everything very carefully, maybe they're not quite there yet. So don't just assume that everything's perfect and you need an audit, double check a couple of those things, and maybe you could at least defer it for another year or two. So
yeah, force outs, I always recommend, if you can force them out, because they're not with the plan anymore. Get rid of those little accounts, because frankly, for some of your vendors, you're paying a PEPM anyway.
Yeah.
Why pay on those people that aren't gone and have little accounts? One other thing I'll throw out there is, since it is getting close to year end, is it's time for plan amendments. So if you made changes to your hardship provisions to your plan, and you haven't already done so, you need to make sure those are signed by the end of the year to be effective. It's one of the first things they ask for in a DOL audit is give us all of your plan amendments, because they're checking for timeliness. That said, also on forfeitures, I think of the 3 or 4 audits I have open right now from the government, forfeitures are one of the largest sticking points. They just keep digging and digging on how that money was used and what it was used for, and did you do it timely? So do pay attention to those.
all right, well, thank you so much, everybody. I'm going to give each one of our panelists just a chance to give any final thoughts they have. So Carrie, I'll start with you, and maybe if just real quickly in your final thoughts, you want to touch on the limited scope audit change that's coming up, just briefly.
That's quite a big one, but so limited scope is going away, and auditors, we used to disclaim the opinion if we had a limited scope audit, but those are going to now be called an ERISA 103A3C audit, and there will be a two-pronged opinion with that. And there's some increased responsibilities for the administrators as well as the auditors. So for more information, go ahead and reach out to myself or Beth if you have questions, or
Yeah, we're going to push out some articles on this as well. There's a lot of information already out there on this. We've known this has been coming for a while. But yeah, they don't like the word limited scope, so they're going to take that away from us. So,
yes, they are.
Okay, Paul, how about you? Any final thoughts?
Yeah, I think we're issuing continuing education certificates for anybody that's participated a minimal amount of time. I don't know what that magic number is. I think it's 50 minutes. Hey, document this webinar as fiduciary training, DOL will ask about fiduciary training, and you can say, yes, I attended the webinar with HORAN, VonLehman, and Graydon. Maybe you attended all four, so all the better. So
Good idea, Paul.
I think any training you can document is always good. Sort of final thoughts for me are, just pay attention to how you set your relationships up and how it runs through the year, because all that planning you're going to do is going to make it so much easier when you get to the audit. If you've sort of done everything you think you need to do, and you've got your relationships, and you have checks and balances, and you have those nice feeds with all your vendors, it's going to make your life so much easier when the auditors come in, and the smoother it goes for them, the sooner your audit gets in, and you're filing on time, and you're not having to worry about any kind of bad letter from the Department of Labor saying, hey, why are you late? And, well, I'm late because I couldn't get my auditors all the stuff, so they couldn't finish the audit while I was trying to dig through a shoebox somewhere to find the right stuff. So preparation is always good.
Yeah, fantastic. All right. Well, John, Carrie, Paul, thank you so much. I'm going to turn it back over to Katie.
Thanks, Beth. As she said, thank you, John, Carrie, and Paul. Huge thank you to HORAN and Graydon for your continuous partnership on this series. It's been a successful year, and we look forward to hopefully doing this again in 2022. A couple more housekeeping items before we log off. If you were on the call for at least 50 minutes, you will be receiving a continuing education certificate from me in the next day or so. If you don't receive it by Friday, please check your spam. And then if you still don't receive it, let me know, and we'll try another avenue. Within that follow-up email, I will also send the contact information for all three of our panelists as well as our moderator. So if you have any follow-up questions from them, feel free to reach out to them. And that concludes our event. Thank you to all of our participants, our panelists, and our moderator, and everybody have a great day.
Have a great day, guys.
thank you. See you.
Bye.